A residual value guarantee is a guarantee made by the lessee to the lessor in regard to the leased asset. The residual value of the asset is guaranteed by the lessee, being that they will be held liable for the difference in value between the residual value and the fair value at the end of the lease. When accounting for this, the amount that is expected to be paid under the lease in regard to the residual value guarantee is included in the cash flows to be discounted when determining the value of the lease liability. Let's look at an example scenario. Let's consider an entity that has entered into a new lease for 3 years. The payment's $100,000 payable at the end of each period. The lease is subject to a residual value guarantee that the leased asset's fair value at the end of the lease will be $500,000. Thus, under this residual guarantee, the entity insures the value of the asset to the lessor up to $500,000. The entity anticipates that the fair value of the leased asset will be $450,000 at the end of the lease. Therefore, the expected payment under the residual value guarantee will be $50,000. We can begin as usual with the measurement of our lease liability. Let's stop and think about what we need to consider in terms of our liability. We know we have fixed payments which are $100,000 each year. We do not have any variable lease payments. We do have a residual value guarantee of $50,000 as previously determined. We do not have any purchase options, and we do not have any termination penalties. As such, we can simply plot these out per period for discounting. We know we have $100,000 each period, so we can plot them out per year. We also know we have the $50,000 anticipated residual value guarantee payment at the end of the period. We can therefore add this to the payment for the final period, $100,000 fixed payment plus $50,000, giving us a total payment of $150,000 for the final period. We can then calculate our discount factor for each period and populate this in the table. This slide has been included for reference. Please pause to read if you need to, otherwise check out the video on simple leases for more detail. And we can then multiply these through to determine our discounted payments and total them to arrive at our lease liability. Let's look at the right of use asset now. Let's think about what we need to consider. In this case, we have our starting point, the lease liability. We do not have any payments at or before commencement of the lease term, nor any initial direct costs or dismantling and restoration costs. We can therefore simply take the lease liability value as our right of use asset value. We can post our journal to recognize initial measurement as such. Right of use asset and lease liability debited and credited respectively to the extent of the lease liability initial measurement. Moving on, we can now begin working out our lease liability and right of use asset schedules for subsequent measurement. Our lease liability schedule will begin with our initial measurement of the lease liability. We can then add interest by applying the interest rate to the opening balance. In this case, 5% multiplied by the opening lease liability. We can then deduct our payment for the period. This will give us the closing balance for the period, which will be the next period's opening balance. We can follow this through for each year of the lease term. If we have done it correctly, the closing lease liability in the final year should be 0. Moving on to the right of use schedule, we can once again begin with our initial measurement of the right of use asset. We need only to calculate our depreciation expense and deduct it each period to arrive at the closing balance. This is calculated as the initial measurement divided by the number of periods of the lease term. In this example, it is 3 years. Our opening balance less depreciation gives us our closing balance. We can note the accumulated depreciation for clarify. The closing balance for one period becomes the opening for the next, and we can follow the calculation through each period. Again, if done correctly, the right of use asset in the final period will be 0. Each period, we can debit depreciation expense and credit accumulated depreciation right of use asset. Journals can be posted based on the schedules prepared. As an example, the first period is shown. Each period, interest expense will be debited to expenditure, with the lease liability credited. The lease liability will be debited to the extent of the lease payment for the period, with the credit to cash, payables, or expenditure depending on the circumstances of the entity's accounting process. Depreciation will be debited to expenditure with accumulated depreciation on the right of use asset credited. This can be done each period based on the lease liability and right of use schedules for the following periods. And with that, we have appropriately accounted for residual value guarantees under IFRS 16 leases. Thank you for watching. If you found this video helpful, Please like, subscribe. Feel free to comment any topics you would like to see addressed in future videos. Check out financialreporting.wtf for more. See you next time.